Imagine waking up this morning and discovering that silver, yes, the same industrial and monetary metal that trades around $90 an ounce on COMEX futures, is actually changing hands in Shanghai for more than $110. That's a $20 premium, a gap so wide that even veteran traders are shaking their heads. Overnight markets were rocked. Asian physical dealers reported frantic buying. Bullion vaults in Hong Kong and Singapore saw delivery queues spike, and Western traders, anchored to a lagging futures price, were left asking, why is the East willing to pay far more for metal that's supposed to be fungible? Today we're unpacking that divergence, what just happened, what it means for the global silver market, and why this might be one of the most important price signals you'll see this year. Let's start with the facts. Over the past week, Shanghai silver prices tracked through the Shanghai Futures Exchange HFE and local over-the-counter premiums have climbed to approximately $110 per ounce on a delivered basis. Meanwhile, the COMEX front-month silver futures contract in New York has been holding around $88-92, with average daily volume still robust, but pricing clearly lagging the physical market. That's a $18-22 disconnect between the world's two most important price references. What triggered it? Chinese retail demand exploded. Photos started circulating of long lines at local bullion shops in Shanghai and Beijing. Physical deliveries soared. SHFE delivery notices were up sharply for several sessions, while COMEX warehouse stock stayed tight. Dealers in Hong Kong and Singapore reported shortages of 100 Oz bars and kilo bars, pushing premiums above $5-7 per ounce over London fixed prices. This isn't a trivial spread. A $20 gap implies a divergence of more than 20% between Eastern physical and Western paper pricing. And in markets, 20% gaps matter. To understand why this is happening, we need to break down the market into its core components. Futures markets on COMEX. Silver is primarily traded as a futures contract, a promise to buy or sell metal at a future date. These contracts are heavily influenced by institutional flows, speculative positioning, hedge fund strategies, and increasingly algorithmic trading. But futures aren't physical metal. They reflect expectations, not deliveries. Right now, speculative net longs in silver futures have been moderate. Volatility has been subdued relative to gold, and most institutional managers appear hesitant to push aggressively higher, given lingering concerns about global growth and rate expectations. That's resulted in a relatively stable paper price around $90, even as physical demand picks up. Physical supply. This is where the story gets interesting. Physical supply, meaning actual mined silver refined and available for delivery, is far tighter than paper markets suggest. Mining output remains constrained due to energy costs and labor issues in key producing regions. Secondary supply recycling has not kept pace with rising demand. Fabrication demand, particularly for EVs, solar panels, and industrial electronics, is increasing year over year, so physical inventories are being drawn down. Meanwhile, markets like China, India, and the Middle East don't trade exclusively through COMEX. They trade actual metal, and right now they are paying up for it. Technical levels. From a technical standpoint, silver's futures chart shows a resistance zone around $95, $98, a strong support zone at $85, $88, a breakout above $100 hasn't occurred yet on COMEX, so paper markets are technically range-bound. But physical markets don't care about chart patterns, they care about supply and demand. And that's where the divergence is being born. Institutional positioning CFTC data shows that managed money positions have been trending neutral to slightly long, not aggressively positioning for a breakout. Contrast that with physical bullion holdings. ETFs like SLV and PSLV have shown net inflows recently, but more importantly, retail physical demand in Asia is at multi-year highs. This reflects a structural split. Western institutional players are cautious, anchored to macro risks and rate expectations. Eastern physical buyers are acting on supply scarcity and perceived long-term value. That's a recipe for a sustained price disconnect. Now let's connect the dots with broader global dynamics. Federal Reserve policy. The Fed's policy path remains a major anchor for precious metals. Even though inflation has cooled from its peak, the market still anticipates intermittent rate cuts, or at least a pause in tightening. That keeps real yields relatively attractive, which traditionally pressures non-yielding metals like silver. But here's the nuance. Physical consumption doesn't care about rate expectations. Industrial demand in China and Asia doesn't pause for rate decisions. So while Western futures markets are locked onto macro signals from the Fed, Eastern physical markets are locked onto actual metal flows. Inflation and currency instability, inflation remains a backdrop. Emerging markets are experiencing higher inflation than developed markets. China's CPI has been volatile. Local currencies in Southeast Asia and parts of the Middle East have experienced periodic weakness. When local currency weakens, buyers often turn to hard assets like precious metals. That's another driver pushing physical premiums higher in those regions. Geopolitics and supply chains. Geopolitical tensions, whether in the Middle East, Eastern Europe, or trade relations across the Pacific, have exposed vulnerabilities in global supply chains. For metals like silver, which rely on global mining hubs and complex refining networks, disruptions can have outsized effects on physical availability. Buyers watching these risks tend to hoard real metal, not paper contracts. So, geopolitical risk isn't just abstract fear, it's manifesting in inventory draws and higher physical prices. This is where the disconnect becomes critical. Paper markets, futures, highly liquid price discovery happens continuously, influenced by macro positioning and hedge funds, carries high leverage, but paper markets can detach from reality when physical flows matter. Physical markets governed by actual metal availability, priced on supply and demand in real time, exposed to delivery bottlenecks and inventory constraints. And right now, physical markets are pricing scarcity, not speculation. That $110 price tag in Shanghai reflects limited inventories, immediate delivery demand, retail and institutional buyers willing to pay spot plus premium, logistical inefficiencies, pushing premiums higher when people can't get physical metal at the published price. Premiums widen, plain and simple. This is not new to precious metals markets. Historically, physical premiums have foreshadowed major moves. Remember, futures markets can price expectations, but physical markets price reality. Let's draw parallels. 2008 financial crisis. During the crisis, gold futures often lagged real hard asset prices as physical premiums spiked. People wanted metal, not promises. Silver also saw significant divergence when inventories tightened. 2011 silver rally. At the peak of the 2011 silver run, COMEX prices spiked, but physical premiums in Asia climbed even faster. Dealers frequently sold out of inventory and delivery queues formed. The key lesson: when physical demand overwhelms supply, premiums rise before futures prices catch up. COVID-19 shock. In early 2020, COMEX saw historic price dislocations due to liquidity stress. But once markets normalized, physical markets again commanded higher prices in regions with tight supply. These precedents tell us something important. Physical price signals often lead paper markets, not the other way around. If Shanghai is willing to pay $110 today, futures markets may eventually have to adjust, especially if physical shortages persist. Now let's step back and think objectively about where prices could go from here. I'll outline two contrasting scenarios. One bearish, one bullish. Bearish scenario: why prices could fall, futures market correction. If speculative positions unwind, COMEX prices could retreat toward the $80 region. Global economic slowdown. Weak industrial demand from major economies could reduce silver consumption. Fed policy surprises. If inflation remains tame and the Fed delays rate cuts, real yields could rise, pressuring non-yielding metals. Inventory replenishment. If mining output increases and inventories rebuild, physical premiums could compress. If these factors align, then both futures and physical markets could see downward pressure. But notice this: even in a bearish scenario, physical markets may remain elevated relative to futures, because scarcity is a structural issue, not just a speculative move. Bullish scenario. What could trigger a rally? Now here's where it gets interesting. Persistent physical shortages. If inventories continue to fall, premiums could rise further, forcing futures prices to catch up. Monetary policy shocks, unexpected inflation resurgence or currency instability could push investors into real assets. Industrial demand acceleration. Growth in EVs, solar, electronics, sectors that use silver intensively, could tighten supply further. Geopolitical disruption. Any major supply chain shock, whether from conflict or trade sanctions, could amplify scarcity. In this scenario, silver prices could accelerate sharply, not just in Shanghai, but across global benchmarks. Imagine a world where COMEX eventually breaks above $110, not as an anomaly, but as a catch-up to physical prices. That kind of shift would reverberate across commodities markets. If you're an investor or even a curious market observer, here are the key levels and metrics to monitor. Price levels: $85, $88. Critical short-term support on COMEX: $95, $98. Immediate resistance, zone $100 plus, psychological breakout level, Shanghai $110 plus premium, track how that spread evolves, inventory data, COMEX warehouse stocks, LBMA London inventories, SHFE and Shanghai OTC inventories, ETF, holdings, SLV, PSLV trends. These inventories tell you whether supply is tightening or loosening. Delivery notice. Rising delivery notices on futures exchanges may indicate actual metal is changing hands, a physical signal that often precedes price shifts. CFTC positioning data monitor manage money positioning, net longs versus shorts, to see whether speculative money is entering or exiting the market. Macro indicators, inflation data, CPI, PPI, FX volatility, especially in emerging markets, Fed rate decisions and commentary. These broader signals affect sentiment and money flows. Let's distill this down to 3 clear points. 1. The East-West price divergence isn't random. Shanghai's willingness to pay a $20 plus premium reflects real physical demand and supply scarcity, not speculative hype. 2. Paper and physical markets can decouple. Futures pricing is influenced by macro positioning, but actual metal moves based on supply and demand. 3. The current premium could be a leading indicator. History shows that physical price pressure often foreshadows broader price moves, especially in tight markets. So what does this all mean? We're living through a moment where the numbers don't lie. The East is signaling demand that the West futures markets haven't fully internalized. That gap you're seeing, the $90 price in New York versus $110 in Shanghai, is not just a market quirk. It's a real signal about supply, demand, and global financial psychology. As investors, analysts, and curious observers, our job isn't to chase headlines or hype. It's to watch the data, understand the structure, and think critically about what these price signals mean. Because when real physical demand outpaces paper markets, history shows one thing clearly: the truth in prices eventually catches up. Keep your eyes on the levels, follow the inventories, and don't be surprised if markets start to align with physical demand leading the way. Thanks for watching. If you want deeper weekly breakdowns on this divergence, world metals markets and macro drivers, make sure to hit that like button, subscribe, and turn on alerts, because the story in precious metals is far from over.